Hey, Mike Swanson of Wall Street Window here. In the last video, I talked about why I believe we're now in a cyclical bull market. I talked about the thrust breadth indicator and how it's given a powerful confirmation of this rally, something it's only signaled 25 times since 1945. And every time the stock market went up for at least 6 months, only once out of those 24 times, the 25th time was last week, but only once was it down 12 months later. So 23 out of 24 times up in a year. But what is a cyclical bull market? How long will this last? How high will things go? That's what I want to talk about with you today. We got to understand what bull and bear markets are. I talk a lot of times about the classic book, Secrets to Profiting Bull Bear Markets by Stan Weinstein. I recommend that you read that. And how it emphasizes the 200-day moving average. When you're in a bear market, the market trends below it, and it acts as resistance, the 200-day moving average, which is what happened last year in 2020. But now the S&P is closed right around it, and most stocks are above it, which is what I was pointing out a week ago. The percentage of stocks above the 200-day moving average is close to 60% now. So here's an article, and I'm going to get into more depth, but this is kind of like the basic stuff you find on the internet. How do you know if you're in a bull market? It's considered a period of time in which prices rally 20% or more. They'd say, you hear that a lot. Bear markets are 20% declines. Problem with that type of thinking is once that 20% move happens, the move has happened, especially a bear market. Oh, now we're down 20%. Well, thanks. You should have told us, before. That's why the 200-day moving average is more useful to understand. This is really this 20% stuff. It's not very useful, but it's like the common way people talk in the mainstream media and CNBC. Now, this is an interesting bit here in this article, and I'll link to it. How can you tell if a bull market has ended? Well, as I pointed out in 2021, hey, the internals are peaking and going down. Watch out, the bull market's going to end. And now, in 2022, in October, November, the internals went up as the stock market went a little lower. That's how you tell. But anyway, this is what they list as the ways to tell. And I think this is interesting. High inflation, rising interest rates, geopolitical instability, recession, overvaluation. Well, look, they say this is when a bull market has ended. Well, think about all these things. What has happened in the past couple of years? The 2020 in 2021 madness in the stock market with rampant speculation, all these people opening up Robinhood accounts, no idea what they're doing, crypto exploding, all that crap peaking out, meme stocks, in January 2021, that whole crap or thing, it was like nothing I'd seen since 1999 of internet stocks, and the stock market was overvalued. Okay, high inflation. Well, inflation started in 2021 and it went higher and higher. So yeah, that was there. Rising interest rates. Oh, well, interest rates, went on a rate hiking cycle. In the summer last year, the size of the hikes went to 75 basis points. And where are we now? We're right at the end of the cycle. So all these things listed here, geopolitical instability. Well, we have the war in Ukraine last year. Recession. What do we got? Pockets of recession. The housing market is come down, likely to continue to go lower. The tech industry is a wreck. Layoffs at Meta, at Google, at Amazon. A lot of the tech industry is a wreck. But it's a weird economy, kind of like I would say stagflationary, sort of like the 1970s, elements of that. But these aren't things starting now. These are things that were 12 months ago. This is old news. These are the things that create bear markets, but this is rear view mirror. All right. The stock market, all these things already happened. Stock market already fell. In fact, now inflation is coming down. The annualized rate is coming down. I'm not going to say it's defeated and gone for good, but it has peaked. The interest rate cycle, we're reaching the end of it, and the rate hikes have shrank. And it's really that that you can time the shift of the internals of the market, the rise of gold and silver turning up, foreign markets turning up, really the stock market as a whole, inside the stocks inside the market turning up. When the interest rate hikes clearly were being reduced from 75, now we're to 25. That was the real turning point. Not for tech stocks, not for the former leaders of the previous bull market. They led on the downside in 2022, and they'll continue to do that. So anyway, and they list all these. This article wants to talk about the biggest bull markets in history. I don't think we're on the verge of the biggest bull market in history, even though I think we're starting one. So how can we understand what to expect here? Well, the video I did last about the breadth thrust showed that basically the market has a good return for the first 12 months. And if you look at the history, at least since 1929, the shortest cyclical bull market was 2 years. Okay. Now, what's important also, so most cyclical bull markets, they say they last 2 to 5 years, the shortest being 2. But there's a secular trend too. You can have a secular bull market that lasts for 10 years or longer. 1982 to 2000 marked a secular bull market in the US stock market. And 2000 to 2010-11 marked a secular bear market. So from 2000 to like 2012, even though there was a minor high, made in 2007 that didn't last, overall, from 2000 to like 2010, stock market went nowhere. The Dow, the technology stocks were down almost the entire, from 2000 to, they underperformed gold during those over 10-year time period. That's what happens in secular bear market. You can have years of returns or upward returns. 2003 to 2007 was a cyclical bull market, but it peaked out and new lows were made in 2009. In the 1970s was a secular bear market, and that's the period highlighted on this chart. But you could really start that in 1967 to 1982, and I think that's the kind of frame of reference I'm using to think about where we are now, not the 2000 to secular, that 10-year period after 2000, which I experienced, but more like the 1970s, because we've seen the high inflation of that time period, which came and went. You had years of high inflation, and the Fed would raise interest rates, inflation would come back down, the stock market would go down as the Fed was raising the rates, things would bottom out, and then eventually inflation would reappear. I think that's the type of environment we're in now. It's not to say inflation's going to accelerate, now. I still think inflation's going to continue to go down as it has been trending down recently, but in a couple of years, it may explode up. And the inflation in the 1970s started in 1967. That's financial history, but what's important is notice. I just want you to take note about this chart of the Dow went nowhere. No meaning, never made a new high and kept going up. It would just smash back down from 1967 to 1982. That's what a secular bull market is. A cyclical phase is 2 to 5 years, and those cyclical bull markets can happen within secular bear markets. And I think that's the situation that we're in now. So we're not going back, in my view, to the way things were before 2022 at all. More like the 1970s. So although I am now officially bullish, saying it's a cyclical bull market, don't confuse me with Cathie Wood or at all. So let's give an example of the shortest. I think this is the shortest bull market. No, it's not. We'll go look at two of them. So this is one of the cyclical bull markets in the 1970s, from 1970 to 1972. Doesn't look like much in the chart, right? And you can see this sideways trend a little more clearly that I was telling you about. Now, if we scroll down, we can see what happened monthly. And I just want you to notice that most of the gains happen in the first 12 months. And that's typical of cyclical bull markets. Most of the gains happen in the first 12 months. And I think that's going to be the case now. And last year, I wasn't thinking this is a cyclical bull market. What happened to me is I went to almost complete cash in July, but I bought back in October, in early November, late October, early November. But I wasn't thinking, oh, this is the start of a bull market. I bought gold, silver, mining stocks, mineral stocks, material stocks in foreign markets. What I was seeing was that the interest rate cycle was changing. We're reaching the end of it. That was clear. And the dollar got hit. And I shifted into things that I believe would benefit from the change in that cycle. And it happened to be the same sort of things that benefited the most in the 1970s. And I think we're, again, in a similar secular cycle. So gold, silver, foreign markets, I think, are the best investments. But most people just invest in the U.S. stock market. And that's kind of what I'm focusing on here. But what happened was after New Year's, really not this weekend, but the weekend before, I changed my view because of the internals turning up made me recognize, this is bigger than I thought. And I started buying high dividend paying stocks that have stable earnings that are above their 200-day moving average. And I highlighted a couple of them, and we'll continue to watch and highlight more. I'm not likely to do much more buying. I already got the buying I need, and I'm already positioned. But one reason I was focused on dividend paying stocks is that I think that after this year, there may not be that much more upside to the stock market itself, and the dividends will be important to have. So that's one reason I got into really focusing on dividend paying stocks. I also think that what I saw looking through sectors was that these defensive consumer cyclical stocks, coal companies, these sort of things were the leaders since October, along with copper, mining, and so forth. So it's a unusual sector strength that we're seeing. It's not growth. It's not the traditional growth stocks, technology stocks. This is more like old school industrial stocks. Again, this is what happened after the market REITs added to this. Banks are doing well now. This is more on the par of what happened after the internet bubble bust in 2000. The leadership shifted into this, tobacco stocks too back then. And this is also sort of what happened, not completely, but some similarities in the 1970s. There was a group called the Nifty 50 in the late 60s, which are so similar to the Teslas, the Facebooks, these fad stocks everyone got so obsessed with, still are. And those stocks lagged for over 10 years at the Nifty 50. I think that's where we're heading for, the leadership shifted. So I think we're seeing a leadership shift. So here we draw down closer. Again, you can see more clearly what I'm talking about. Most of the gains happen, in this bull market from April to April, 12-month period, and then you had a correction and sideways action for well over a year, and then a breakout that was a trap. So again, just to emphasize, most of the gains in 12 months after that, it's kind of it, and that's that's typical of a cyclical bull market within a secular bear market. Again, that's what I think we're doing. That's why once you get that first year, 12 months, I think the dividend paying stocks are going to be really important to be able to have a positive return. People in their minds, I know, as still think, oh, they think 20% returns a year are normal in the stock market because they saw that in the preceding couple of years up to 2022, but it's not normal to have back to back. It's just that was just an anomaly. That's not what you should be expecting here. So that's a example of a cyclical bull market in the 1970s. Now let me show you one of the shortest bull markets, and this is saying it's 1 year, 1967 and 1968, but not exactly 1 year, as you'll see. Here it is on the chart, and you can see, it doesn't look like much of an exciting move, part of a sideways overall trend. But if we look down, here's a closer look at it. And actually, if I'd have to, Warren Buffett was running a hedge fund. He started in the 1950s and basically closed it down, returned his investors money in 1967, might have been early 68, but during this bull market near the top. And he said, I think the stock market's done, and I'm giving you your money back, and I'm out. And that was his hedge fund, and he made all these people money and then closed it down. What have you ever heard? That's what he did. And he personally bought back in and started his Berkshire Hathaway operation in the 74-75 bear market. But the market had a terrible bear market. After he sold, it made a new high and then crashed. And then it was all part of this. You had these short-term bull and bear markets within this long period. Again, repeating it, but it's so important. I think that's what we're sort of in now. But we're in a bullish period. And here's what it looked like. And it was really more than 1 year. When you see this, the bottom was October 66. And you had big gains, and then a minor new high right at the end of 68. That was the top. So you really were looking at a 2-year bull market here, although this thing called it 1 year. I'm not really sure why it's calling it 1 year. They made a mistake. But this is one of the shortest cyclical bull markets. It may be the shortest, actually. And that's why I'm drawing it to your attention, And what was the percent return? It says 50%. Well, I'm not telling you the stock market's going to go up 50% here. What was the return here? 80%. Well, again, I'm not going to tell you that the stock market's going to go up 80%. But as I said in the previous video, if the S&P 500 from here goes up to its high, not even hitting it, just close to it, it'll be about a 15% return. I think 20%, whatever. This is why I think dividends, it's nice to have dividend paying stocks because it helps with your overall return. So my thinking as it stands now, if I had to take a guess, I think this can last for 2 years. After that, who knows? We could fall apart. And one thing that's going on is the Fed is near the end of its rate hiking cycle. And then you have the presidential election year next year. And historically, that's one of the best. That's out of those, that presidential election cycle, the election year is the best, and then the market goes down after that. And the funny thing about this period of the inflationary 60s, late 60s, 70s, is the presidential cycle is key because the Fed was repeatedly pressured by LBJ and Nixon not to raise rates during the presidential election years, and then raise them after. They would raise after, and then the stocks would get hit. So I wouldn't be shocked if that's what we don't see something play out, where the Fed is going to throw in a couple more rate hikes, small ones, and say, okay, we're done. They don't want to tip the economy into a huge recession and then have to cut. That's the last thing they want to do. That'd be a complete disaster. So they want to hold and do nothing. Once they get 2 or 3 more rate hikes in of a quarter point size, and they may be cutting next year or towards the end of this year if the economy softens, because they'll be under pressure to do so. But they won't want to do it by much. But either way, it sets up a good backdrop for the stock market. When you look at the interest rate policy, it's also a lot of ingredients for a weak dollar. And the way the US dollar worked is they fixed it to the price of gold until they went off the gold standard in the 70s. But in the 60s, gold, was fixed to the dollar and being bought up by foreigners and putting pressure on everything. And they had to get off the gold standard, the Bretton Woods system, that is, as a result. So, that's a recipe for, I'm just trying to tell you, falling dollar is in the cards here, which is bullish for gold and silver. Copper stock's been the top gaining sector since October. So it's metals across the board. So anyway, interesting times we're in, and it's nice to be able to see reasons to think that the stock market could go up instead of be warning you that it's going to fall, or pointing out that we're in a bear market. So if you got any thoughts, leave them in the comments of this video. Hit the like button. And if you're new to my YouTube videos, hit subscribe, hit the bell next to it, and YouTube will send you an alert as soon as the next video is up.